you both for sharing with us. Next is I guess when we started, we're not totally technology focused. I guess that reflects certain economic development stage. So we're sort of taking a opportunistic approach to looking at whatever the risk-reward ratio that justifies, I guess, when the market is not crowded and the economic development stage are, you know, at the per capita income of between from $500 to $1,000, the basic industry should have a lot of opportunities. So if you look at what we have invested in the last 6 to 5 years, it's really from all kinds. We have control deals that are in batteries, in packaging. We have bought to the middle of consumer growth, mostly the private sector growth stock in the consumer brand names. We also have a little bit venture type in like the media and software. When we're raising funds, you know, we're saying you're not a VC, you're not bio, what are you? That kind of. But actually, we feel the risk-reward ratio, at least in the past, has been concentrated on the growth capital side. We have been able to identify a good risk-reward ratio. I think one of the reasons probably is because the Chinese capital market is not very efficient. When they're not efficient, they're not providing the kind of financing role that in the more developed country, those companies probably go for IPO direct, would need a private equity round, in particular when there are peculiarity of the Chinese capital market that it's become a necessity to have a private equity round in order to achieve registered trade for the founders' shares. But if you look at the what in terms of opportunity in the last 3 years, it's better than what we anticipated. We have invested in 9 transactions. Actually, 5 of them have the market cap today of more than $1 billion, and mostly in our traditional industry. And that's kind of quite encouraging for the investment opportunity that we see. The full spectrum of industry that growing like a very high rate. I want to just make one example of this dairy product. A dairy product in the US and Europe probably have a 0 growth. But in China, they have in the last 5 years and 30% growth. The top company growing like 100%. You essentially don't undertake huge technological risks, enjoy the fast growth and the purchasing power of the consumer. And you get an opportunity to create household names within a 5-year period. And that growth aside is your established competitors in the state-owned enterprises are relatively weak and they're losing market share. So you have the whole industry growing and your competitor relatively weak, and you really get a good risk-reward ratio there. So if you look at those companies, 80% of the value creation is from the organic growth, very little leverage, multiple expansions probably wash out by the dilution of ESOP and the capital market IPO. But I guess in Europe's presentation, there's competition coming. I guess this kind of doing everything by ourselves is probably not in the long run solution. I think we do see that there's more opportunity in creating new companies, and we do see the venture type of investment needs different skill sets, needs a different mentality even, different people. So we decided we're going to focus. We're going to more focus. I think there will be more focus in the industry, specializing what you're good at. So the whole team decided we're good at counting bins, so we'll continue to count bins. So we'll give the venture part completely to a new team. And so hopefully if you look at the portfolio today, is like a football, that the bulk of the investment in the growth capital. But in the more developed country, when the capital market gets more efficient, the portfolio of the private equity become by elementary, more like a barbell type of shape. But that's going to take time. I think if you look at the next few years, the opportunity probably with the risk-reward ratio continue to be in the broad spectrum of industry will have a good growth, but they're going to grow at a different period of time. But we need people more specializing in the venture side as well as the growth. So we're going to split the business. That's the few theme that we're looking at. One of the past investment has been mostly focused on the consumer. When per capita income grow, there are certain industries growing faster than the general economy, and that's mostly the consumer related. The other is, I would say, the consumption from corporate consumption to individual consumptions. We have seen that through the housing 10 to 5 years ago. We've seen the cars. 5 years ago, all the prediction was saying that private cars are not possible in China. If private citizens start buying cars, the road will all jam up. Today, all those predictions were wrong. We see others, policy change. We'll not be able to invest in financial services. Now, when policy change, we'll be able to invest in. I also see the deepening of the technological base of many of the industries. And those, hopefully in the next 20 years, is like what Japan did in the 60s, 70s, and Korea and Taiwan did in the 90s, to creating more technological, industrial, and service companies. I think China would have that opportunity. Two-thirds economy in the state-owned enterprise, the restructuring that have other type of opportunities, but I don't want to get involved in that at this